Hey, what's going on, everybody? I want to tell you some of the things that underwriters are looking at when they're evaluating your file, right? So first, they're always going to look at time in business. Now, you're asking, well, what does time in business have to do with anything? Well, typically the way it works is the longer you've been in business, the less risky you're considered, all right? Because most businesses fail within 3 years, and actually most don't make it past the year. So the longer you've been in business, the better off and less risky you're going to be perceived. There's a lot of ways around it, but I'm going to give you guys some markers, right? 7 years plus, you're golden. Once you get past that 3-year hump, that's a big accomplishment. Certain lines of credit, they start at 2 years or older for businesses. And then it gets broken down by, year one. And once you make it past year one, other options open up to you. And then there's some high risk options that are, from 6 months on, you may qualify for. Now, the way around this, okay, to navigate this is a term loan. And what I mean by that is a term loan is only going to go off of your personal credit and your provable income. So that's a big plus. Now, another thing to consider is if you own multiple businesses. If you own multiple businesses in the same field, you can get away from that time and business requirement. Or if you're buying into a business that you have substantial experience in, those are all things to get around that time and business requirement. All right, but time and business is a very, very key metric, key stat that a lot of underwriters look at. Believe it or not, another thing that underwriters look at are reviews. Okay, so strong reviews help. If you have a lot of reviews and they're positive, that's going to help. When an underwriter pulls up a file and sees, maybe 50, 3-star reviews, they start to wonder. And this is all in the finance and technology space, right? But I'm sure banks have adopted some of this. I'm not talking about recent programs going on now, like the EIDL or the PPP, because those are totally going off of different metrics, which is a little crazy, And obviously, we did a whole training on credit. They always look at credit, okay? I don't, if some pro or some guru is telling you they don't look at credit, they're lying. They absolutely do. So time in business is a big one. Reviews are a big one, so you want to keep those up, okay? They want to see, a lot of times, a clean website helps too, and you should be soliciting reviews because it's social proof, that clients or customers have had a good experience with you and that they would come back and they would highly recommend you. Next, okay, believe it or not, and this is 2 parts because this could really be a very, very long video. Next, they look at what types of financing you've had in the past. All right, and what I mean by that is if you've had lines of credit, an SBA loan or a term loan, that's a very, very strong positive. When they see multiple advances, which are daily or weekly payments, that can hurt an application because it's constricting your cash flow, right? Now, there's a difference between high-level fintech companies and low-level ones, and here's the difference, and here's what I want to get to. If your company has taken certain options from predatory companies, right, it is much harder to get you approved. What I mean by that is, I rank lenders, okay, in the fintech space, A, B, C, D, all the way to F. When you have balances from C lenders, D lenders, all the way to those F lenders, it raises a huge red flag. First off, nobody wants to pay those guys off because they're much more likely to step in and stack. And second, it questions why someone went there in the first place. Whether it was a good opportunity or not, you had to do it or not, I'm just telling you the facts. Okay, don't get mad, don't kill the messenger, right? So that's some of the things that they're going to be looking at. Next, okay, is when you have those bad positions or bad lenders in there, how do you get around it? How do you pay them off? Well, you could use a term loan to pay them off. You could also use asset-backed financing to pay them off and consolidate, whether you have equity in a house, equity in trucks, or equipment. Those are ways to get around that as long as your credit score is good, where you can come in, pay all those guys off, and get more sensible financing. Now, let's talk about the other aspects that they're looking at The other aspects are going to be cash flow. Okay, cash flow is a big deal. What I mean by that is they want to see, how you manage your cash. Okay, and when I talk about cash flow, there's a lot of different metrics. One is, what are the average daily balances? Okay, and how do they relate to the total revenue? So if you're consistent in doing $100,000 a month in sales and revenue, and you're keeping $10,000 in the bank, those are good metrics, right? And it never goes negative. If you're doing $100,000 a month consistently, and you're keeping $1,000 in the bank and it goes negative 3 to 4, 5, 6 times, that's a negative. Okay, they're going to look at that, they're going to ask about that, and it may impact the types of financing you can get. Another thing when it comes to cash flow is how consistent is it? Are you always doing 100,000? Are you a seasonal business that goes, from 100,000 to 50,000 to 40,000 and then ramp back up? So they want to see how consistent that is. They also want to see the number of deposits. The more deposits you have in a business, that they equate that to having more customers and more stability. All right, so if you're doing 10 plus deposits, that's a very good sign. All right, and there's ways to, if you're not doing that, I would deposit some of the cash. All right, and make sure you're always keeping good, clean, average daily balances. Right, they don't want to see negative days. So let's just recap that. Cash flow. They're looking at the consistency and how much you're depositing. They're looking at the number of deposits, and they're going to be looking not just the number of deposits, but how much you keep in the bank at all times. Okay. Next, for higher end, better types of financing, like an SBA loan or business loan, they want to look at profit margins. Okay. So for an SBA loan, to qualify for the $350 in working capital, you only need to show $45,000 to $50,000 a month, a year in profit, right? So don't write everything down all the time to save on taxes, because if you needed to get an SBA loan, that's gonna impact that. All right. The more you show, the more you're gonna qualify for. All right. That's just simple. Any type of business loan that's either SBA or a traditional business loan, they're looking at your profit margins, right? They also want to see what your retained earnings are. They want to look at your balance sheet, all right? When they're looking at a balance sheet, they want to see what assets you have, how aggressively you're depreciating them, and they want to see that you have positive equity in the company. If you don't have positive equity in the company, that is, scary to a lot of underwriters, because if you have negative equity in the company, it's easier to walk away from the business. Now, you and I know most people won't walk away from the business. That's what you've built. That's your baby. I get that. But these are things to consider when you're doing your taxes, when you're looking at your returns. Okay, so profit helps. Okay, make sure that you're claiming, 30, 40 or more thousand each year, because it will open up doors for you financed to get good financing. All right. They're going to want to look at your balance sheet like we discussed. Those are all things, all key metrics that they're looking at. And if you're not sure what I'm talking about, ask in the group, because these things are very important. All right. Just some advice, you should be keeping monthly statements and quarterly statements. Get an accounting service. If you need one, I'm happy to make that connection for you. All right. You should know your numbers each and every month. That's how you're going to dial in your business. That's how you're going to grow. That's how you're going to scale. All right. So every month you should be reviewing those statements. I sat in a class or an event with Mr. Wonderful, and he said, you should be monitoring your monthly statements. It should be, your Saturday thing. The last Saturday of the month, always go through your financial statements for each business you own, and kind of see what the trends are, and then see what you can improve on, right? That is so key, and that, a lot of business owners don't do that. So if you're not doing that now, start. And if you're saying, hey, I can't afford an accountant or a bookkeeper, well, there's plenty of solutions like QuickBooks where you can plug in and get those statistics in real time, just so you can monitor it, because that's how you're going to plan and forecast for the future, right? You want to set goals. If you want to double your revenue and double your profit margins, well, how are you tracking those metrics? All right, so always know your numbers and always know your metrics each and every month. When you apply for financing, another thing that people often make the mistake of doing is, instead of knowing exactly what they want, they guess. You should go in, anytime you apply for financing, you should know exactly how much you need, exactly what it's going for or going towards, and how that's going to help you grow and scale your business. That makes a huge difference. If you can articulate those three things, right, you're way ahead of anyone else that's applying. And if you could show, hey, if by getting this piece of equipment or by throwing this money into marketing, you're going to increase your business 20, 30%, right? When you go to apply, whoever you're applying through, that's giving them leverage to champion for you, okay? So, just recap. Your time in business matters. Your past financing matters to a degree, okay? Reviews matter. Your credit absolutely matters, okay? Having accurate statements is important, and knowing exactly what you're going to do with the funds, how it's going to help you, is vital to getting approved, right? So any questions, drop this in the group. I hope this really helped you, and I look forward to seeing you on the next training.